Yeah. Oh, ooh, yeah. Amaru, yeah. Turn up for the night. Real thing, she's no average girl. Too fine, oh, she might. She's so damn fine. I just wanna call on you. Money just fall on you. Another thing I won't do. Ooh, yeah. Yeah. I just wanna call on you. Let me do it all for you. Can't nobody ball on you. Ooh, yeah. Yeah. She the girl in my visions. Now that I found you, I'm feeling for all your attention. Yeah. Hope you don't mind if I give you a tour of my mansion. Yeah. All of this for you, babe. Nothing I won't do, babe. Weak for your love. Everywhere we go, it be alright. Yeah. Can't help it with your body. Just wanna make you happy. I just wanna call on you. Money just fall on you. Another thing I won't do. Ooh, yeah. Yeah. I just wanna call on you. Let me do it all for you. Can't nobody ball on you. Ooh, yeah. 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 Turn up for the night. Real thing, she's no average girl. Too fine, oh, she might give up on the baggage, girl. You got too much going on in that mind, let me help you. Yeah. Let me give you the moments in your life to step to. Fly away together. Can't help it with your body. Just wanna make you happy. I just wanna call on you. Money just fall on you. Another thing I won't do. Ooh, yeah. Yeah. I just wanna call on you. Let me do it all for you. Can't nobody ball on you. Ooh, yeah. Yeah. Just wanna call on you.
Laugh it to the bank like ha 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 ha. Ooh, go, go. Laugh it to the bank like ha 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 ha. Ooh, yeah. I got it in tens, 20, 50, hundreds, tens, 20, 50, hundreds, tens, 20, 50, hundreds, tens, 20, 50, hundreds. Laugh it to the bank like pedal to the floor, need no brake lights. In the dark, watch me make light. I'm a star, got no stage fright. Please don't get me mad, I'm a nice guy. My baby say I'm cute, yeah, I'm tight fine. I be waking up when you go night-night. In a different zone with the time. Laugh it to the bank like ha 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 ha. Ooh, go, go. Laugh it to the bank like ha 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 ha. I got it in tens, 20, 50, hundreds, tens, 20, 50, hundreds, tens, 20, 50, hundreds, tens, 20, 50, hundreds. I get it, I flip it and continue. I've been going dumb, I've been going mental. Going up, I'm on another level. All black clothes like a medal. Little this and this, little Rick and Rick. It's my grandmama, I'm her Nicky Nick. I just wanna love, but I've been hit or miss. I might up and leave, yeah, take a pic. Laugh it to the bank like ha 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 ha.
Mr. Fundamental People.
What's happening, guys? Welcome to the second stream of today. It's very, very important. In 20 minutes, we have the FOMC meeting. We're gonna cover this live, especially for you. We have Uncle Jerome in the building, the uncle that I never had. It's very, very exciting. Looking forward to today's stream, or the second stream, to go over exactly what we need to go over, and that is the macro understanding of the market and potential pairs that we're currently looking out for on, of course, the higher time frame. So no scalping at this particular stage here. We're really gonna try to nail down exactly what will happen during the FOMC meeting. Looking forward to that. I just want to do it one more time.
Mr. Fundamental.
There we go, there we go. Sorry guys, I just love it so much, man. Our Uncle Jerome. Looking forward to what he's gonna say, what he's gonna teach us later today. I mean, what he actually means, right? This is what we're gonna discuss here. It's gonna be absolutely fantastic. We're gonna go over gold, we're gonna go over the euro against the US dollar. And I'm gonna go over the indices as well. A lot of people are talking about Bitcoin as well. Bitcoin is potentially making a move. I think it's a very, very interesting moment today, okay? So just to give you guys a good preview here, we're gonna go over the actual... Let me put on some really, really nice... Give me 1 second, guys. There we go, that's nice. All right. Just to go over the investing.com/economic calendar real quick. What we want to like to see here right now at this particular moment is the following, okay? We want to look at investing.com/the economic calendar. If you want to look yourself as well, I sent you a link right now so you can be updated completely. All right. Then looking at the 3 stars right here, we have, of course, a couple important things to do here today, okay? The most important thing is, of course, the FOMC interest rate decision. The crude oil was bullish. The ADP, non-farm employment change, was bullish for the dollar index. But the most important conversation will come in 50 minutes from now, which is going to be the FOMC statement and the interest rate decision. And then in 45 minutes, we're going to have the actual press conference. So for a full, let's say 1 hour and a half, we're going to face a lot of, pretty much a lot of volatility right now. And I'm very, very curious how this will be operating right here. Okay. Just to go over the charts right now, we have the dollar. We broke the daily low. This is super important here. Okay, we are filling up the inefficiency right here. We have that range. We have this whole area of consolidation as well. We have to take that in consideration right now, that supply is in this case in control, that potentially can come into play right here. Okay, can we still come up? Absolutely. We can still break it. We can come up and continue our journey to the upside. But do keep in mind that we're nearing the yearly close, okay? We're nearing the yearly closure right now. That means that it's almost 2023 right now. We have one more rate hike or interest rate hike in December. I believe it's somewhere around mid-December. I need to be correct here. Let me check this for you guys real quick. Yeah, exactly. Mid-December, December 14th is the last potential rate hike right now. Today is the final rate hike of the year. This could have a major impact. I do believe that potentially right now we could get led into the wrong direction as well. We have been going up and going up and going up and going up with the dollar. The question remains right now, is it time right now, because we're nearing the yearly close, right? Yearly closure candle as well, that it's time to come back down a little bit. That's the question right here. The forecast is 4%. This is also going to be interesting. Is it actually going to be a 75 basis points hike? Okay. Or is it time to start playing around right now with different kinds of numbers? That will be very interesting as well. Okay. So there are many questions we have to ask ourselves. We have to be very careful. We cannot just confidently say right now, we're going to go up or we're going to go down. If I knew that 100%, then of course it would have been a completely different story. But that's just not the case, okay? We really need to observe and we need to look at the chart, and based on that we need to try to see if everything is aligning here. However, the most important metric I'm personally looking out for is liquidity. Where right now is most of the liquidity at this particular moment built? Okay? And I have to say it's a little bit on the 50-50 side, but if we look at the area of supply here, supply is in control. I see that there is a lot of liquidity built up very clean right now. Again, very clean underneath these zones right here. Is there a big chance that you can take that out? In my opinion, absolutely. Looking at the euro, I see a very, very similar thing right here happening right now at this particular moment as well. Looking at the 4 hour, we had that massive shock. We came back down, but we came back down very slowly. We came back down very slowly. Yes, we filled up some inefficiency right here. However, where's the liquidity build? Right, this is what we're looking for right now. I'm very, very careful here right now in terms of actual trading, but I do believe right now we could be quite bullish as well at this particular moment for the Euro USD. This is potentially the trade setup I'm currently looking for. A Euro against the US dollar, a trade setup at this particular moment. Okay. If we are going over gold, gold is a very, very interesting one right now at this particular moment, because gold also have been building out a lot of liquidity right here. Also underneath, okay? But we still have this zone here. We are still balancing above this area of demand here. This is a weekly area of demand right now. We can put on the Sonar Lab as well. Let's put on the Sonar Lab right here. Let's go to the 3 daily. This is exactly that area of demand that we're in right now, after taking out all of these equal lows here, all of these equal lows that were built here, right? Taking out all kinds of weekly levels right here. Strong liquidity grab to the downside. Right now stabilizing here and forming some sort of potential double bottom structure. Again, we have to wait. We have not created any higher high whatsoever. We are still relatively bearish for gold, right? However, what we're seeing here again is the liquidity building out on the upside. And again, guys, look how clean it is. This is something that I'm personally looking for. And this is how I personally cashed out a lot on the CPI. We saw the exact same thing happening. We were coming down significantly, right? Coming down. And then CPI came out and then boom. All that liquidity was taken right here. So this is very, very interesting here. Are we going to see and witness the same? We will find out in a matter of minutes right now, okay? The indices. I'm very curious to your personal belief on the indices right now. I'm going to create a poll at this particular moment. And I'm going to ask you the question right now. What do you think personally will happen with the indices? We're talking about the Nasdaq. We're talking about the S&P 500. We're talking about the Dow Jones. What do you think will happen with the indices right here? I'm gonna write it down. I'm very curious to your response as well at this particular moment right here. Let's see what we have here. Bullish, bearish. Fantastic. Okay. The poll is up here. I'm very, very curious to your potential response right now to see what we can expect and what the community is actually saying or thinking it to happen, because we can definitely take that in consideration right here as well. Okay. Tariq says, I'm from Sydney. I'm in Sydney. Had some crazy weather lately. Mr. Q says raining season. Absolutely. Pip Destroyer. Sydney lad. Ivy Lensburg. I'm from Perth. Amazing, 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 amazing. I love Australia as well. I live in Bali right now. The last couple of years. So I'm actually not that far away from Perth, I believe. From Western Australia. Indeed, a lot of rain. Right here at this particular moment, it is the raining season right here. So when it's the raining season, we have some internet problems sometimes. That's what you have to deal with when you're living on an island, all right? That's just the way it is here. Our man Trash Woodshop is back. What's happening, man? Hope you're doing well, my friend. Great to have you back on the streams, my man. Great to have you here. Amazing. Adrian says I'm from Slovakia. Fantastic. Amazing. Gary's back. Gary Larby, my man. Thank you for joining again. Great to have you back, my brother. Tanisha, our sweetheart, is here as well. Mohammed M. What's happening, my bro? Jose is here. Kirui. Jamie. Fantastic. Everyone is here. P Sniper, my man, is here. Great. Justin Rondo as well. Justin, I just saw your message on Discord. Sorry, it's a little bit late. But I will come back to you as well, my friend. So, guys, absolutely amazing. It is absolutely fantastic. We're looking for the potential reaction here. However, you always know how it goes with liquidity. Let's say we're aiming for the upside here. Okay? Let's say we're aiming for the upside right now. Alright? Then what we always see is that we massively come down and then come back up. We're always going very volatile here at the beginning, at the open of the statement right here. Okay, we have around 7 minutes to go. I'm personally aiming potential bearish, bullish for gold here and the euro against the US dollar. I could be completely wrong, but hey, I look at where the liquidity is. This is where I base my trust on right now at this particular moment. And also the fact that we're nearing the yearly closure. Plus the fact that we saw the daily weakness now on the dollar index. Also, first time in what, 6 months from here. Or 6 months ago, okay? So, I put these things together. I analyze the interest rates. I'm also looking at the interest rate differentials again. So, what have the other countries been doing lately? They have right now decided to also massively increase and scale up these interest rates as well. So, they're also gonna follow up and scaling their positions here. Okay, I do believe that this is gonna be very interesting. As well, Omar says, sincerely, I'm interested in your strategy. I'm going to watch again the second time your YouTube video. Fantastic, my man. Absolutely looking forward to that. So far, let's see how many votes we got. We got 114 votes. Oh my god, man, ladies and gentlemen. 52% is bullish. And 48% is bearish. It couldn't be closer right here. 118 votes, so pretty significant here. It's really 50-50, and I understand why. And especially when you're looking at the indices right here, there's something interesting happening here, okay? The VIX has been coming down. We have been taking out some lows here. This is very interesting. I do believe we're gonna take out, potentially fill up that gap here. It's just a high likelihood that we're gonna come down here, okay? If we come down to fill up that gap here, the question remains, are the indices then gonna go up? Yes or no? This is very interesting, right? Because right now we're coming back down, but have a look at the indices right here. Let's go over the US 100. Okay, we have been going up here. Right now, of course, right? We know that there's a strong inverted correlation here. But we're also building out the liquidity underneath, right? So we have to see it from a different perspective here. So there is, for the first time, I see a different kind of decoupling happening as well. Same as what we're seeing right now with the dollar index, okay? So it's very interesting what we're seeing for the indices right now. And that's why I ask you guys these questions right now. What do you guys potentially think? 55% of you guys are bullish right now, and 45% of you guys are bearish. So it's gonna be very interesting. I'm personally focused a little bit more. We're gonna go over the indices as well live. I'm focused a little bit more on the euro against the US dollar and gold at this particular moment here. Guys, also smash that like button. You would highly, at least you would help me out tremendously with the algorithm. Not the algorithms in the market, but the YouTube algorithm. It's apparently super important, and you know, we've been streaming a lot here, so it's good to have more likes so we can grow our community. So thank you so much. In the meantime, we have 4 minutes left, guys. I'm very curious as well. Gary says gold has been bearish for 7 months now, so I agree with you, and that it could go up before the end of the year. This is exactly what I'm looking for. I indeed do think that we have been going up all year long with the dollar index. Let's have a look here at the daily on the dollar index right now. This is pretty much from February at this particular moment. Let's go to the weekly here. Tariq, my man, thank you so much for the support. Much love, brother. We're gonna give it back to the community straight away with the magic keys. All right, shout out to you, my friend. Pretty much from mid 2021 we have been going up here, but pretty much the whole year around we have been going up consistently right here on a regular basis until right now, pretty much for the first time since May. Okay, so that's 6 months ago. We have created a lower low. It's very, very interesting right here. Yes, the last time we created a higher high. We are still building out liquidity on the upside. It's very, very 50-50 right now. But I do believe that looking at gold, looking at the euro against the US dollar, look at the VIX, look at the yearly closure, looking at how bearish we were all year, look at the liquidity that's built up also underneath, looking at for the first time we have created that lower low on the daily since a long time. I do believe it's very, very interesting in potentially what we are seeing right now happening for the dollar index right here. Very, very interesting here. We're going to keep it open. We're going to be waiting right now. We have 2 more minutes to go, guys. I'm also very, very curious what we will see. We'll see the volume increasing tremendously right here. We're going to anticipate right there. I'm personally looking for the euro against the US dollar at this particular moment. Okay, let's put on some music indeed. Our favorite song. We need a new favorite song, but right now we're going to get some energy going because we have 2 minutes left. Let's listen to this song while the news comes out here. So we can witness all live together. A chart on your screen. Go up and down. Let's go. One minute to go, guys. There we go. There we go, there we go, there we go. We're bullish, we're bullish, we're bullish. We're coming down. Let's see, we have 1 minute. Let's get going. Okay, 4%, guys. 4%. Nothing crazy here. 75 base points again. I have to say 4% is significant. It's definitely significant here. Okay, this is not going to be good for the Japanese yen. I can tell you that right here. All right? Let's see how we play out here. It's going to get very, very interesting right now. Wow, guys. I'm gonna put my stop loss on break even. There we go. I'm in a massive EU trade right here. Like I stated right now. Massive EU trade. I'm gonna secure myself already. Let's see how we develop here. Wow. Big trade right there. I'm gonna close 50% of my position. Already. 50% of my position closed. Right now. Wait for that reaction here. Still going up. Liquidity, guys. Liquidity, ladies and gentlemen. Liquidity is getting built up here. Okay. Bullish for the indices so far. Gold going up. Euro, liquidity. This is what we're looking for. Okay, I'm gonna close 50% of my position. There we go. That's $3,500 in a couple of seconds. Stop loss on break even. Boom. That's it. Easy, easy. This is what we're doing here. Keeping it very, very secure right here. I'd rather make secure profits, okay, than doing that. Right there. Boom. Stop loss and break even. Let's see what we bring right now. We have a break even trade right now for the euro. We have been cashing out already 5 lots right here. This is liquidity, ladies and gentlemen. Let's go. We can still come up, but hey, where was the liquidity built right here? Underneath that zone. When I do not have the answers, I look at the overview right there from the higher time frame, looking at what we can expect from that particular moment. Okay? Macro fundamentals. What's happening? Okay, yes, we have been going up. Daily chalk, yearly candle closure. Where is the liquidity built right now? Okay? There we go. If I get stopped out on break even, no problem. We take it easy. We look for a new potential opportunity later on. Alright? We cashed out $3,500. We wait now. We're seeing what's happening here. And we see how we can anticipate right now on the next move right here. Okay? This is what we need to do right now at this particular moment. Be very patient. However, eurjpy. This is how I like to approach it. Okay? Whenever I see a clear zone of liquidity, I tend to take the risk here. Okay? I tend to take the risk. Looking for a trade setup. Okay? Keep my stop loss very tight. Alright? And trying to go for it. If I get hit, it is what it is. It's like a normal trade. If it doesn't go for it, I still, and it goes into my direction, I try to close 50% of my profit as soon as possible. Okay? I leave the rest running. This is what we're doing here, especially during news right now. Beautiful reaction so far for the euro against the US dollar. Gold is also trying to come up here. However, we potentially can turn around right now during the actual FOMC meeting itself, to the press conference, okay? Keep that in mind. We can still turn around here. Very, very interesting right here. We're gonna close the poll here. Let's see what the reaction will be eventually. You guys were bullish, and indeed what we're seeing right now is also a bullish indice right now. We're coming back up here, which is very, very interesting as well, because it seemed like we had more imbalance to be filled up. We have more zones here. But, like we said, what did we see on the VIX? VIX is coming down. What do we see here? We have liquidity here, and we have that gap right here. If the VIX comes down, most of the time the indices go up here. That is what I don't get. If the interest rate is increasing, why would the dollar not increase? It's all about speculation right here. It has been happening already indeed for the whole year that the dollar was increasing here. This was also the first time that we created a daily chalk, right? Plus the fact that we are entering the end of the year right now, the end of the year cycle. What most of the time happens is at the end of the quarter, you see a turnaround happening. In the last quarter of the year, they try to pull it back towards where they came from. Most of the time, right? Another fact was that on the euro pair, which is the biggest competitor right here in terms of Forex, right? The euro against the dollar, liquidity built up on the upside. All right, a lot of liquidity was built up here. In order to get that liquidity, the dollar needs to come down. It's simple as that. Overall, very beautiful reaction so far. Let's see what we're gonna do. We're gonna wait for the euro. Oh, sorry, for the euro. For the FOMC meeting coming out here, the press conference itself. And we're gonna exactly see what we can expect from this particular moment right here. What a beautiful, beautiful reaction here. If you guys know, we have been stating this already for a while ago already, I believe, in the mentor charts as well on our Discord. Okay. Looking at this particular setup right here. We have been looking at this setup already for a while right there. This is what we were looking for. To come back down, tap into that zone, build the liquidity, and then come back further up. Our first target will be that particular high at 101. It's going to be very, very interesting right there. This is indeed what we potentially can head towards. However, during the press conference, we can still go in every direction. We can easily turn around here. This is exactly why I potentially took my profits already. Why I took 50% of my profits out. I can sleep at night. Okay, if we come back to my entry, I can sleep at night. I will have a fantastic sleep. Alright? This is what we're doing here. We're trying to really, really nail it down. 20 more minutes till the press conference itself. I would love to go over some charts for you guys. So let me know exactly what you guys want me to discuss here. So we can move forward from there, guys. Hassan says, will gold break the 1675? Let's have a look here. I see what you mean. Absolutely. I think it's definitely possible here. I think we have a lot of liquidity built up above this range right here. I think we have this liquidity built up here as well. Right? Remember? We talked about this one as well before. This is the liquidity that they're going for. I think this makes a lot of sense here. We're going to face some resistance right now. This is a very, very strong order block that we're creating here on the 4-hour. It's a very strong zone here. This particular zone right here. Do take that in consideration as well. This particular bullish, bearish, bullish candle right here. Okay, that bullish formation. We have all that liquidity built up above that range here. I do think there is more upside potential for gold. Also from a weekly level right here. Right, we have forming that double bottom here. This is the semi-final rate hike increase of this year. We have taken out all the liquidity of these weekly lows already. This is what we're waiting for. Are we going to create a higher high? That's the true question here. In order to become structurally bullish right now for gold, we have to create significant highs still. We have to come all the way down to all the way up to the 70-30 range, which is significant. Okay, but looking at the liquidity here, this is where the stop losses are at right now. I'm gonna get a drink real quick, guys. I'll be back in 1 minute. I want to get ready for our Uncle Jerome here. Just so you guys know. Let's see what he's gonna tell us. Okay, the euro is coming back down here. Danisha says liquidity is king. I completely agree here. Absolutely, absolutely. Let's see if we can find another... There we go, there we go, there we go. There we go. We're looking at some songs here, ladies and gentlemen. We need to get prepared here. Darren Lee says, how is EU? EU is doing well, however, we can definitely come down in the short term here. We have an entry at 98.762. Alright, 98.762 right here. This is where we placed our position right there. Look at that liquidity built up for gold here, ladies and gentlemen. Look at that massive order block as well on the 4 hour. I do believe that there is more upside potential for gold right now. And I do think that we were right so far in what we're seeing happening. Alright. Roberto says it was a slow move for today. I think that the worst has yet to come, my friend. We are still coming with a press conference. And I think that more volatility will definitely occur the moment the press conference will be given right here. That's going to be interesting. We have created a 4 hour change of character right here, ladies and gentlemen, as well. We came back down here, also on the 1 hour as well right here. But this is also very, very interesting right here, guys. We have created a lower low right now on the dollar index as well. Okay? At first, I was looking at these equal highs right here. But based on the EURUSD, based on gold, based on other metrics right here, I was looking at the liquidity that was built up underneath that zone. Very, very interesting. I'm very, very curious to the press conference as well. Let's see what we can do here. Will we show the press conference? Absolutely. We're gonna look at it live. We're gonna watch it together. I still stay in my position here for the euro against the dollar. I decided completely to stay here. Absolutely. The reason why is we cashed out already around $3,500. That was my goal. To pretty much get it 50% out at a certain moment. Leave the rest in. And see how it develops here. Because I do believe in more upside potential over time for the euro right here. Okay? I do believe that we can come back up right now. Why? Because this is exactly what we have seen before. We know that when we were watching the ECB interest rate Christine Lagarde speech, she was at the beginning a little bit moi. Along the way, she was way more fierce. She was way more strong, right? Dominant about the fact that we need to fight inflation. They need to higher the interest rates right now. So I do believe that the ECB is going to dramatically increase their interest rates over time in the next coming months ahead of us here. And the moment when the euro was dropping so much, I mean, significantly, was the fact that the US Federal Reserve was completely hiking the interest rate, increasing the interest rates constantly, while the ECB was still at 0.5%. So this is very, very important here. Of course, there are some other metrics involved as well in regards to the euro. But I do believe right now, in the short term, there is some catching up to do here to the end of the year as well. Zulka Harney Hater says, any new trade that we can pick? I'm currently in the EURUSD here. Gold is something that interests me as well. Gold is coming very nicely. If we create, let's say, a pump right now and we come back down here, I'm looking potentially for another entry right there. Around this zone here. But I just want to be very sure that we are remaining in that same bias, in that same direction here, when the press conference has been finished. It's going to be very interesting. It was catching that first move, but potentially right now, this could be very good. The liquidity is beautifully built on the upside. The imbalance is here as well. We have been consolidating significantly for a while right there. So let's see how we develop from here. I must say the indices were not really going for it here. Yes, we saw a beautiful reaction. We came back to that zone here. We took out these highs from this particular level here. People that went short here, these highs have been taken out right now. But in general, I expected a little bit more of an aggressive move personally. Especially in regards to the US 100, US 30 and US 500 here. However, of course, there is still a chance that we can experience that in the next coming hour. Right? Nicholas says, where do you explain your 1-minute strategy? In my YouTube channel, there's a video that's called the fair value gap liquidity hybrid strategy. You will find it there. Fantastic, fantastic. English communication with Kevin says, help, bro. What's happening, my man? Hope you're doing well. The FOMC meeting, we're gonna look it up already. We're gonna prepare here. Very, very interesting, ladies and gentlemen. Looking forward to share this with you guys and see what will actually happen during the FOMC here. Give a link of that video. Look at my channel. Fair value gap liquidity hybrid strategy.
We knew the 75 was coming. Anything inside the language surprised you, in particular the mention of the lags with which monetary policy affects economic activity and inflation?
Well, I think you and all the prior guests who just spoke before me are focusing on the right things. That the addition of that language elevated the importance of the idea that when you get closer and closer to a destination, you slow down, just like when you're driving a car. And that's what they're telling us. The acknowledgement of the lags, the cumulative tightening that's in the pipeline, the signal is clear. They're getting closer to their pause. It'll probably be early to mid 2023, call it 475 or 5. And then they have.
Guys, are you still bullish on the US 100? Let me know. Are you still bullish on the indices right now in the next hour? Do you think we're going to see a turnaround? Yes or no? We'd love to see that in the chat right here.
Stop and wait to see the cumulative impact of the tightening. The fact that the bond market is reacting with the steepening, where 2- and 5-year yields are double digits richer, makes some sense. This new language, I think, forecloses, at least for now, the concern that they're going to keep going 75. And I think it affirms expectations that were built off of recent FOMC members' speeches and appearances that this day was coming, this idea of slowing the pace and getting closer to the pause.
But RJ, when we're getting closer to a destination, I'm looking down at my GPS and I'm seeing the time go down 10 minutes or so. We're not seeing that in inflation. We're still at a 40-year high. What evidence is there that we are closer to the destination, which is 2%?
I'm going to stay with the car analogy.
Okay.
If you are going to drive your car by looking solely in your...
Helmer says, we're going bearish, ready for sale. Nolan says short term maybe. Redland says, did the DXY go up? Mark Anthony says, I think bearish for the Nasdaq. Bearish. Okay, very, very interesting.
It's undeniably clear that monetary policy is not instantaneous. Mortgage rates have surged, but other interest rate sensitive sectors are only now starting to feel the pain, the cumulative impact of a sharp and aggressive tightening that is already underway. They need to look through the windshield as to where the car is going. Lags take time to overcome. We cannot set policy solely on realized past inflation. The Fed is heartened, by the way, by the fact that inflation expectations are all pretty much south of 3%, whether you look at tips or you look at surveys. So they are acting in a manner that keeps those expectations relatively contained, and they can't set policy solely on realized inflation. It's like driving a car looking solely in the rearview mirror.
So RJ, then, in terms of what we saw with Q3 real GDP, obviously we know that the Fed is data dependent, but with so many different indicators pointing in different directions here, what does this mean for not just the likelihood of a recession, but how deep of a recession we might be headed for?
Q3 GDP was an upside surprise propelled heavily by the surge in exports and the drop in imports. The post-pandemic world has been dominated by heterogeneous reopenings, all kinds of distortions to global trade patterns. Who actually thinks exports are going to keep growing?
Visual says, ask a very, very good question here. He says, what is the correlation of inflation rates with currencies? So you can use a formula that's that helped me tremendously out. You can deduct the or subtract currency B from currency A in terms of the inflation rate. And if you're ending up with a positive or negative number, right, a minus or a non-minus, so a number in the plus here, you will find out potentially where they want to move price towards to in, let's say, the higher time frame. So from a fundamental standpoint. And this is exactly what we have been seeing. This is exactly what we have been seeing right now. And especially, man, in regards to the US dollar against the Japanese yen, this could have been maybe the best trade of the year if you were early here. If you were early here seeing that everyone was increasing their interest rates except the Japanese yen here.
New language that we've all been talking about is going to get questions from the media that's assembled in the room there. They're going to want to drill down for further meaning there. It's a challenge that Chairman Powell faces getting in front of them at any session, but he actually has a unique challenge now. This language, which I think was unanimous across all the voters, suggests that they're opening the door to the pause. It's not right away, but we're getting close. We're getting close to our destination, as I said before. There's going to be a lot of questions about how the market should interpret that new language. Why was it put in there? Clearly, the committee, on a unanimous basis, feels like it belongs there. Can Chairman Powell still sound hawkish on inflation while acknowledging the need for a pause and not open the door to a huge rally? Former President Lockhart mentioned it earlier. It's a tough act. It's not an easy task to communicate such subtleties to the markets, which often trade on sound bites. So there's the risk that he gets up there and tries to talk back or walk back the language in the statement. That seems like a low risk. I think he may elaborate on it in a way that will get further bullish response from potentially equities and from the intermediate part of the Treasury.
In case you guys want to know which broker I use use multiple accounts here, but one of my accounts connected to BlueBerryMarkets. This is exactly the broker that we're using. We have been approached by many different brokers out there. They are by far one of the best I've seen so far.
If you were in that room with Jay Powell, what would you want to ask him?
Interestingly enough, I think that the bigger questions come down to quantitative tightening, the Fed's plans with respect to the balance sheet. They've made their pace of balance sheet reduction abundantly clear, but there's plenty of talk, including talk at the Treasury Department, of the need to sort of bolster liquidity. Bond volatility, both implied and realized volatility, has been extraordinarily high this year, and liquidity conditions have likely something to do with that. I'd be interested to see what Fed staff at the Federal Reserve Bank of New York, working with the Treasury.
Okay, it's going to be very interesting, guys. We're going to wait for a couple of minutes, and then we're looking for the real meeting here. I'm going to answer a few questions right here. We have a question from Nicolas. He says, how did you create your 1 minute strategy? Okay, the way I created the 1 minute strategy was, I was trading supply and demand. Okay. I was trading supply and demand for a significant amount of time, and I got annoyed on the lower time frame. I was also trading supply and demand on the lower time frame sometimes and scalping sometimes. Just supply and demand right here. And I got annoyed. And the reason why I got annoyed was that the moment I saw it breaking structure to the downside, right, or a change of character to the downside, the moment I saw it happening, it sometimes never came back to that particular order block. All right. So I had my buy limit, my sell limit, and so on and so on. And I was waiting for that retracement back up, but it never came. After a while, hundreds and hundreds of trades down the line, I got annoyed. I was like, you know what? What if I do not no longer enter from that area of supply, but I enter when that level breaks, when that change of character takes place or the break of structure comes into play, and I put my stop loss above that area of supply. This is what I have trying to do here, and I was trying to work with it, and that's how I came back to this hybrid strategy here. This combination of SMC, ICT, supply and demand, and horizontal support resistance, and market orders, stop orders, and so on. So 4%, guys. I'm very, very excited. Actually, it's exactly what I expected. But hey, it could have been 4.25, right? How would have the market? How would have the market reacted when that would actually come into play, right? Very, very interesting. The Young says, where can I find your strategy? I have a video on my YouTube channel, my man. You can find it right there. You can pretty much look up that strategy right here. It's a liquidity fair value gap scalping hybrid strategy. We did, right now, at this particular moment, total 97 trades, I believe. Let me see right here. Yes, 97 trades, 64 wins, 21 losses, and 13 break even. So we're still testing it. Our EU trade is still going strong. It's stagnating a little bit here. This is the reason why I didn't sell. We are still creating higher highs right now, I believe, on the euro. Let's go on the lower time frame here. I'm not interested in selling at this particular moment. I already took my profits here. So I just want to hold my position and see how it develops here. Our entry is at 98762. All right. 98762. That was right here. Right there. So yeah, this is regular trading, ladies and gentlemen. This is trading with news. Normally, I do not really trade news. The only reason why when I trade news is when I'm confident enough in a particular pair, and in this case, I was confident enough in the euro. And the reason why is, again, the liquidity was so clean. The stop losses here, it was such a clean trend right here built up right now. While we're slowly coming down here, tapping into this major area of demand as well. These combinations, after creating a massive chalk, by the way, that combination was exactly what we were looking for. So yeah, let's see how this plays out here. I'm relatively confident with my entry right now. So I would love to hold it a little bit longer. Even if we come back down, I'm not that surprised. Even if it gets stopped out, it does not really matter. This is what we're looking for here. Tapping into that zone here. And potentially seeing how this can turn around. It can always turn around here. But hey, that's news. So let's go over it. I believe it's live right now. Let's see if he's live here.
To our 2% goal.
There we go.
We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year.
Let's see.
Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs,
We're keep pumping,
and the
guys.
pace of
We're
job
keep
gains
going
has
up here.
slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
Beautiful.
The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain
Gold
evident
going
across
up.
a broad range of goods and services. Russia's war against
Keep out
Ukraine
liquidity
has
above that
boosted
range,
prices
guys.
for
Liquidity
consumer
right
food
here.
and has created
Yes, it's going to be hard to
additional
break,
upward
but
pressure on
liquidity is a lot of liquidity is built up under above this
Despite elevated
above this area right here. We're seeing the
longer-term
beautiful
inflation
reaction.
Expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Indices
That
having
is
a hard
not
time.
grounds for complacency. The longer the current bout of high inflation
Euro keeps
continues,
mooning.
the greater
Wow.
the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly
Let's see if we can make it. There we go.
strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in
5K.
the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions
Keep
have
going
tightened
up.
significantly
Wow.
in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggest that the ultimate level of interest rates will be higher than previously expected.
There we go.
Our decisions will depend on the totality of incoming data and their implications for the
There we go.
outlook
That's a
for
game
economic
changer right there, what he
activity
just
and inflation.
said.
We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained
Indices coming down.
of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against premature...
Lorenzo, are you not disappointed that you closed 50% of your position? Absolutely not. And the reason why is you always, this is rule number one, when you're trading news, always take out profits no matter what. Always take out profits. It does not matter how much you could have made.
To achieve our maximum employment and
Always
price
take profits.
stability.
Price can always turn around here.
Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming
Look
down
at the US 100,
decisively,
guys.
and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
Very important.
What I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover.
Guys, smash that like button for Uncle Jerome.
But before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation.
There we go.
I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important.
We're still
than the
holding
second
here.
and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate. For example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. shorter-term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is...
Arjen says, Lorenzo, any trade ID? Now, I would be very careful here. I would be patient here.
...of high inflation. And we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain.
Liquidity taken.
From a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy. And trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about.
There we go, making moves.
Very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy. We need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks,
There we
Chair
go.
Powell, Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand, a lot of sectors you don't see a ton of effect.
Indices are dropping.
Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't present doesn't appear to present financial stability issues. But no, we do understand that that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that. If you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought, because, and that, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a time, difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy. And we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability, stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin.
Wow, look at that.
The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no bill.
Real quick, guys, before we continue. Liquidity grab, massive dollar index as well. Gold, very, very similar reaction so far to the upside. Liquidity grab to the upside. What did it take out? Of course, that beautiful zone here. A lot of stop losses were built up above that particular range right there. Very interesting. My euro trade, okay, is right now at entry. I got stopped out and break even. That's exactly the reason, Billy Baker, why we cash out. That's the reason why we cashed out a couple $1,000s right here, purposefully. You never know what happens. You can always turn around here, and I will be able to sleep tonight. So we're going to look exactly at how this will develop over time right now. The indices are potentially coming down right now. I think that Gordy D was right, going NASDAQ as well, going back to the 1100s right here. So very, very great analysis right there.
That means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right. And that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as people as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay?
Yeah,
but
there we go.
At some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
All positive?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing. It's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to wage.
Look at Bitcoin. Took out the highs, took all the liquidity on top, then all the liquidity at the bottom. Very interesting.
It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers, and many retailers will tell you that the consumers are still buying, and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Fed Chair Jay Powell just wrapping up his news conference after the central bank raised rates by 75 basis points for the fourth time in a row. Rates now at the highest level that we have seen since 2008. But it was Powell's commentary that really sent stocks on a wild ride over the past 45 minutes or so. He was trying to strike that both that dovish and hawkish tones, going through some of those headlines as to why we saw equities bounce all over the place, the driving factor why we're in the red.
Equities all over the place, yes.
The Dow up 139 points, and Powell saying that it's very premature to think about pausing rate hikes, on pace for future.
Okay, ladies and gentlemen, Uncle Jerome, we have to do it one more time. Absolutely incredible. What a beautiful, to be honest, it was a beautiful trade. It was a Euro USD trade. I got stopped out on break even, but that's exactly the reason why you take profits during news releases. Extremely, extremely important here. But to conclude here, I am more bullish on the dollar index right now. The fact that we came back down here and we created that massive reaction to took out all of these lows here and then create a strong reversal to the upside is very, very interesting here. I do think that we can come back to this range right now, which will cause gold to come back down a little bit more. And also, of course, the Euro USD potentially as well. We have taken a massive amount of liquidity there. So again, if you want to trade during news, the thing that I can recommend is trying to put or create a global understanding, a macro understanding of what potentially could happen here. But look at the liquidity. Liquidity is king. This is how I made my most money during particular news events right now. But the rule is always take profits. Don't try to maximize your profits when trading news. This will get you wrecked, right? Or you lose out a lot of money when you put your stop loss and break even. So this is what we're doing here. We're taking our profits. We're out. Made a couple $1,000s. Boom. Back. And now we're back to reality, okay? This is how we should focus right now. So now it's no time to straight away go in a new trade. What we want to see right now is simply the market to develop, all right? The market to develop again. Relax, calm down, consistently come back up. Let's see what the Asian session does. Let's see how everything pretty much moves around and how we can form new highs and new higher highs, higher lows, and so on. To see if in this case we can create a beautiful higher high, higher low structure in order to move forward. And then potentially look for a new trade again. I think that's the way to go here. I think right now, trading right now at this particular moment, I will be very careful. I do not think it makes that much sense here. I think if you wanted to go for a trade, then the trade was before the news came out or just when the news came out. But not during the FOMC meeting or the press conference itself. Right now, look at particularly all the particular moves that can play out. Look at new structures that can be created. Look at potentially a higher high, higher low. Then potentially look for an opportunity here in terms of gold. Also, same thing right here. Look for a potential reaction. Right, we're still looking at the same thing for gold right now. Again, we took out the liquidity. It was built above this particular range right here. Okay, very, very interesting. So let's see where we can come back down right now. Is it this one right here? We have this area right here. Well, we have to see. We have to see exactly where we need to go to right now. We can still take out these lows and so on and so on. Let the market do his thing. Wait for the Asian session tomorrow. Use the London tomorrow to look for a potential play out right here and see how we can anticipate in the market. Tomorrow we're going to do another stream, guys. Back to normal again. But one beautiful thing to take consideration here, look for the liquidity. Liquidity is going to help you when trading, or at least when looking for potential trade setups. And when you trade liquidity, right, don't try to optimize your results. don't try to optimize your, besides taking profits and so on, what we just discussed. Do not try to get that really tight stop loss here, right? And then risk a lot of money, okay? If you cannot afford it, all right? Really, reduce your risk, set a little bit of a wider stop loss, and try to see if you can actually benefit from it, right? That's the way I think you should approach it, especially as a beginning trader. If you're more advanced, you can trade your own way, and you're a little bit more confident about the overall market. But taking profits is indeed, like best friend said, taking profit is never a bad thing right here. If I didn't take profits, I would have ended up with nothing right now. Okay? So I'm extremely happy. I think it was a great session here. Initially, the fact that we took out all that liquidity was very, very interesting right here. But yeah, from an interest rate differential perspective, it makes kind of sense right now that we are potentially coming up. It does make sense here. However, liquidity never lies, all right? Let's go over a few charts for you guys as well. And yeah, just give me throw me some charts, guys. Let's go over it real quick to see what we can potentially expect here. All right? I think this is important right there. Gayatri says Australian dollar uses USD. Tuni says US 500. Okay. Okay, let's start with Australian dollar. We have been looking at the indices already for a while. Let's look at the Australian dollar to US dollar and let's go back to the indices right then. Okay? At this particular moment, I do think that still at this particular moment, we took out the liquidity, of course. Look at that. We came back up. We took out all the stop losses here. The people that went short here, where are they putting their stop losses? Right above that range right there. Okay? This is taken. Alright? What do we have to do right now? We have to fill up that inefficiency right underneath the zone. Again, from a higher time frame perspective here, we have not created a higher high like we did with the euro. We have created a lower high. Still, on the daily, no higher high here. Okay? So there is still definitely a continuation of the potentially more downside potential. In my opinion, very, very likely. I do think it could definitely occur right now. But it's not going to be easy. And the reason why it's not going to be easy, because we look at this whole area of consolidation here. We have this particular area, which we call the point of control. We discussed this already yesterday, I believe. The point of control right here. A lot of volume stepping into the market right now. I think we're going to test this particular zone. Watch this level at 0.62973 and see how it reacts from there. I think this is exactly what we are looking for. But keep in mind, so far right now, lower high created on the higher time frame. We beautifully tapped into the daily area right here. The 4 area of area of supply here. Daily area, or pretty much daily bias, coming back down potentially. But let's see how this area of consolidation reacts right now. And now we see the consolidation, the expansion. If we come back down and we take then a move potentially up, could be the case. But this is not something I would like to trade. I would wait for a massive higher high, or I would just pretty much wait in terms of the Australian dollar against the US dollar. Edgar says gold. Let's go over gold as well. We talked about gold as well. However, for gold, it's very, very interesting right now, because gold is in an interesting zone at this particular moment. Still, we are in that specific range here, which I do really, really like. We are still at the particular level. It's not gonna be that easy. We have some liquidity to be taken out here, but I do believe that this is a zone that we can potentially take in consideration right here. Okay, that is this zone right there. At the 16.27. 16.27. I think this is definitely a potential setup that we can take in consideration. I'm still looking at gold here, and I do think it's a beautiful momentum here. We potentially can do it and look for a potential setup. I'm still looking for gold. I do think still that we have a way to go here, and we're building more liquidity to the upside here. But that's also very, very interesting. Nobody, my man. Lorenzo, how are you doing? I'm doing very well, my friend. Absolutely great that you were here. Thank you for being here. Glizzy District says, they take profits. Best advice. I was in profit. Got greedy last night. Woke up to one blown account. Aye. Part of the journey, my friend. Part of the journey. We've all been there. I've been there myself as well. Guys, if you like the stream, if you like what we're doing here, please smash that like button. It would help me out a lot here. Beautiful trade today. This is the second stream of today here. But of course, we're going hard for you guys. No problem. We are ready to crush it. Let's go over a few more charts right now. Patrick says, I got stopped out on my EU short and it went out in my direction finally. That's unfortunate, my man. These things, these things happen. These things happen all the time here. However, my advice when trading news is still the same. Look where the liquidity was built. Look where you saw that the liquidity was built here. I think this is a major rule here. We saw that zone on the 1 hour. We saw a massive, beautiful trend here. And that's exactly what they did. They grabbed the liquidity. And then they reverse price back down here. But this is the trade that we took here. We exited 50% of our position. And then it reversed right there. But yeah, if you're trading again around the news and you are still starting out a little bit, then at least try to go for an extremely small position and have a little bit of a wider stop loss, because you know that things are volatile. You should see it more as an earthquake, right? You have that massive earthquake. And then you have that massive thing on that on the radar, and then it goes down again. An aftershock, another one, until it dies out and moves further, right? Or continues further from there. So this is trading with news, and especially during the FOMC meeting here. All right. In the meantime, right now, what is happening here? The indices are coming down hard. The indices are coming down significantly hard right now at this particular moment. Which is quite interesting, okay? Look at that, look at that. We're coming back down right now significantly in a very, very, very rapid pace here. All right? Very, very rapid pace. Look at that, look at that, look at that. Is there more downside potential for the indices? I think so right now. Let's look at the VIX as well. Let's see how the VIX reacted here. This is also very, very interesting right now. There we go. Of course, the VIX is going up tremendously right here. Okay. There we go. We're coming back down. This is very, very interesting. Wow. Okay. We have not taken out these lows. I really expected it to take out these lows to then potentially reverse here. But we're already coming down significantly here with the indices right now. So you can definitely see the correlation right here, guys. So if you want to know more about it, I'm going to share all the indices right now. A watch list of all the industries right here. In the chart. Okay. There we go. Take this as well. Take over these indices right here. Look at the VIX. The VIX is the volatility index. It's highly, highly correlated or inversely correlated to the indices right there. If the VIX goes up or the VOX goes up, indices go down. 99 and 99 out of 99%. Very strong. It's like an 85% negative correlation here. So definitely use it, take that in consideration as well. But you can see when this goes up here, indices definitely go down. Okay? There we go. Still coming down here with the indices right now. I think we're gonna break a little bit. I think the limit here is round about 32,180. I think this is a good foundation right here, a good base right now to potentially see a reaction from. Let's see how this develops here. We are recovering this wick here for the US 100, okay? So we are covering this wick right there. All right. So keep that in mind. We're covering this wick. So very interesting what's happening right now. Gold coming down, not as significantly as the indices right now. The indices are coming down relatively fast here right now. The euro is coming down. I'm happy that we took out the trade. Yes, I could have closed my full position, but hey, it could also go the other way. That's why I was more than happy with the 50% that I closed here. Let's see how this continues right now. In the meantime, the dollar will get... Wow, look at that move, guys. Look at that move. It's very interesting right now. Still a lot of volume in the market. Okay. Tariq says, will there be a Black Friday or a Christmas sale for Discord? I don't think so. No. We're actually going to improve the Discord a lot more than we already have. The value is already insane. We have the Sunday Weekly Breakdown where we analyze all the charts here. So you know exactly what to expect when trading the next week. I think this is super important for you as well. So you don't have to do, you have to do your own research. But still, it helps you out tremendously right here. So everything that we talked about, the euro, gold, and so on, that played out right here in the Sunday Weekly Breakdown. It's an unlisted video on my YouTube channel. You get access to when trading, or when you are in our Discord as well. Besides the fact that we also shared these particular charts as well as potentially, of course, the euro. The same reaction that we see here. Many things that are coming out here. We have in these audiences, we have the voices. Let's see what the guys are discussing.
That's retail.
Equal highs is retail?
No, bull flag.
No, I call it bull. When I say flag, I don't say that the shape of the flag. I said like when a woman wanted to like it's not behaving good and you say like
right. Guys, what a reaction, my man. What do you think about it?
Well, I was ready for it. Yeah. I sent you the screenshots because the price action just closed. When I saw the first reaction to the downside, I go stop out first. I was selling already.
Yeah.
And I go stop out.
Yes.
Because I thought that actually it's gonna come here. Right?
Yeah.
And I can stop out. And then, but when I saw the reaction to the downside, I was like, the price cycle is already closed. I was waiting for sell because I know the Feds are not ready.
Yeah.
Based on news that I have seen and things like that. They're not ready to pivot yet. They don't have the power to pivot. But the hot potato that they have in the head right now.
Yeah. Did you took any? You took a trade?
That down here is open. You can see it.
Oh, you're in a position. Okay, beautiful, my man. Fantastic.
Like with a small amount of money, but like I don't have 5 lots like you. You made like 3K today to the upside.
Yeah.
No, the thing
I wanted to sell at 161.
Okay, I'm gonna be right back, guys. I'm gonna be good with you guys soon. All right.
Okay.
Bye. That's what's happening in the Discord, my ladies and gentlemen. We're discussing charts here, analyzing this. We're giving also a lot of different events as well. But we're gonna release a complete video series mid-November related to everything that you need to know as well. So a lot of cool things are coming. If you want to join the Discord, be fast because we're gonna potentially change some things up here. A link is in the description right there. Anyways, guys, beautiful stream. It was quite insane here. The dollar is going up right now. Okay, we're going for this potential liquidity right now at this particular side. We're always chasing liquidity. We had that massive creation here. This reaction there, taking out liquidity, was our perfect setup. Aligned beautifully with the EURUSD here. That's why we took that position. However, we saw the reversal happening. So very interesting right here, guys. I would, guys, to see you tomorrow at my place right now, at my home. And it's like 3:30 a.m. right now. We are still here, full of energy, especially for you guys. So I'm very happy to be with you all, to continue our journey together, to become profitable traders, to do whatever it takes to improve, to learn, to get these epiphany moments here, and to also, of course, along the way, still test our scalping strategy out. Because we're still working with our scalping strategy. We are at 97 trades here, but we're gonna find an amazing balance between education, news, scalping, okay? Higher risk reward setups are coming into play as well later on. We're almost at the 100 trades. After that, we're gonna make some changes right here. But we are still going for, of course, our scalping journey. We're not gonna quit completely. We're gonna find a very good balance between education, regular SMC, and actual scalping, guys. All right? Let's take over the world. Let's learn how to trade. Let's improve on a day-to-day basis. And the best way to improve is doing that through a community. So one more time, I'm gonna put up our song here. I'm gonna put Jerome Powell on one more time. And I'm gonna say goodbye to you guys. Thank you guys so much. Absolutely fantastic stream. Second stream of the day. Smash that like button. I would highly appreciate that. Okay. My man, Muhammad. Thank you, brother. Tariq. Pip Destroy. Zed. Best friend. The XSH. What's happening? Thank you for being here. Danisha. Jamie. Pizza, these nuts. Funny name, brother. Garden Miss. Aryan, Darren Lee. Nobody. Fantastic. Johnny is here. Johnny Berendog, my man. Thank you for all the support lately. I appreciate you, bro. I see you, man. I am Enjoyer. Kevin. Let's get it. Jerome Powell is the uncle I just never had.